All right, so let's talk about the U.S. housing market right now, in the spring of 2026. You'd think things would be picking up, but the truth is, it's way more complicated than that. It's like a big tug of war, and honestly, nobody's sure which side is going to win. We're going to break down what that means.
So here's the big question, right? Mortgage rates are a lot better than they were a year ago. That should be like rolling out the red carpet for homebuyers. But the usual spring rush, it feels like it's completely stalled out. So what gives? To really get a handle on what's holding things up, we've got to start by looking at the numbers. And honestly, the data is sending some seriously mixed signals. It's like the market is telling two totally different stories at the exact same time. Okay, check this out. This is really the heart of the confusion. Pending home sales, the contracts people have signed but haven't closed on yet, they're up almost 2% from last month. That's good. That feels like things are warming up for spring. But, and this is a big but, they're also down almost a full percent compared to this time last year. See? Total contradiction. It has a lot of people scratching their heads.
All right, so let's grab one side of that tug-of-war rope. We'll start with the good news, the reasons a lot of people thought we were heading for a really strong spring.
So that 1.8% bump, that's Exhibit A for the optimists. It's a sign that buyers are starting to wake up from that winter hibernation. They're out there, and they're starting to sign on the dotted line. It kind of feels like momentum is building just under the surface. And it's not just a feeling. Listen to senior economist Sam Williamson. He points out that the market's on firmer footing. People have more buying power, there's a ton of pent-up demand, folks who've been waiting for ages, and inventory is finally starting to improve, even if it's just a little bit. So the optimistic case is pretty straightforward, right? You've got lower rates, making things a bit more affordable, you've got signs of seasonal life, and there's this huge crowd of buyers who have just been waiting on the sidelines for their chance. It really looks like the stage is set for a strong spring. But okay, now we have to grab the other end of the rope, because for every one of those positive signs, there's something else pulling hard in the opposite direction, pretty much slamming on the brakes. And this is Exhibit A for the pessimists. That drop of 0.8% compared to last year. I mean, think about it. Rates are lower now, so sales should be higher, right? The fact that they're not tells you there's a bigger problem here. Lower rates just aren't a magic bullet. And chief economist Lisa Sturdivant really hits the nail on the head here. It is a classic standoff. Sellers are holding off, and buyers are looking around going, is now really the right time? So you get this cycle, right? No new houses for sale means buyers stay put, and because buyers are staying put, sellers don't bother listing. It's just a market that's stuck in hesitation mode. So if you boil down the pessimist's argument, it comes down to a few big things. 1, people are just plain nervous about the economy. 2, affordability is still a massive issue. I mean, even with better rates, house prices are still sky high. And 3, and this might be the biggest one, there's just not enough to buy. And yet, let's just hammer on that inventory point. Sure, for sale listings are up 5.7% from a year ago, but that's it. 5.7% is a drop in the bucket. It's nowhere near enough to really loosen things up in a market this tight. So what happens? Competition stays fierce, prices stay high, and a lot of would-be buyers just get stuck on the sidelines. Okay, so none of this is happening in a vacuum, right? To get the full picture, you've got to zoom out and see how what's happening in the rest of the world is yanking on the housing market's strings. It's like a domino effect, seriously. Something happens on the other side of the planet, say a conflict that messes with oil prices, that makes bond traders nervous, and they start reacting to all that volatility. And what happens next? Boom. The mortgage rates you see on the news start jumping all over the place. It's a straight line from a global headline to your potential monthly payment. And it's not just one thing. We're talking about geopolitical conflict, inflation that just refuses to go down, big questions about trade and tariffs, all these big, messy global issues. Any one of them could send a shockwave through the system and derail the little bit of good news we've had. So, when you put it all together, what do you get? You get a market that is just teetering, perfectly balanced on a knife's edge, a real nail-biter. I think Mike Simonson says it best here. Conditions are better than last year, but fragile. And that's exactly it. There's this feeling of, okay, maybe things are getting better, but everyone's holding their breath, just hoping nothing comes along to mess it all up. And that's really the word for it, fragile. That is the main takeaway. For every positive signal, there's a negative one pushing right back. The whole thing is so delicately balanced that one little nudge could send the entire spring season one way or the complete opposite.
Which leaves all of us with the million-dollar question, doesn't it? For anyone even thinking about buying or selling. In a market this unpredictable, what's the bigger risk? Making a move too soon or waiting too long for a clear sign that, let's be honest, might not ever show up?